Supply, demand, and the path to utility. What I want to do today is to spend some time talking about something that I think every node operator should understand, regardless of how technical you are or how long that you've been around blockchain. And that is the relationship, again, between supply, demand, and utility. Now, I'm not doing this training because I want you to walk away trying to predict the future price of trusted smart chain. So I want to start there. In fact, I want to accomplish almost the opposite. I want us to get away from just the constant asking, what will the coin be worth someday? Yes, we all have our hopes and our vision and our beliefs and what we think is possible. But I think that there's some better questions. And the better question is, what is being built? Who is going to use it? Why would they need to use it? What role does TSC actually play? And what happens when real usage begins interacting with a supply that is defined by the protocol? Because when you begin to understand these things, you start looking at blockchain very differently. There are really three ideas that I want you thinking about throughout this entire training today. So, first of all, supply, which is how much exists, how much is being created, and how quickly that changes. Okay, so that's the first thing. The second is utility. Is there an actual functional reason for people or businesses to use the network and its native token? And finally, reoccurring activity. Does that usage happen once, or does it continue to happen over and over again? So again, the three things are supply, utility, and reoccurring activity. Those three things together are really the foundation of what we are going to talk about today. And as node operators, this is especially relevant to us because we're not simply people watching the ecosystem from the outside. We're helping support the infrastructure that the ecosystem is designed to run on. So let's talk a little bit about how supply can be coded and how demand has to be earned by utility. So this is a simple economic principle. A blockchain can program supply. It can determine the maximum number of tokens that can ever exist. It can determine how quickly new tokens are distributed. And it can determine whether that distribution changes over time. But a blockchain cannot simply program demand. Demand has to come from somewhere. There has to be a reason somebody wants or needs what is being created. And that is where utility becomes so important. And really, this is at the crutch of our presentation, right? Rather than getting into price guarantees or speculative future value, which puts us into a position where we're now selling an investment contract, we focus on education on utility and what the utility is of the trusted smart chain coin. And we allow people to arrive at their own conclusion about what the potential looks like in the future. And as long as we stay inside that box, from a legal framework perspective, we're good to go. And you're going to notice if you start paying attention to a lot of the other projects, especially node projects that are out there, they don't stay inside that box. And that's the reason why they're not around today, many of them. So let's talk a little bit about the supply. How much can exist? How much is circulating, and how quickly additional supply becomes available? So that's the supply. Once again, it's how much can exist, how much is circulating, and how quickly additional supply becomes available. The second is utility, and that is why anyone actually needs this network or this token. And then again, the third is the reoccurrence, which is how often does that need to repeat? And that last piece is incredibly important because there's a huge economic difference between something somebody needs one time and something that has to be used repeatedly as part of an ongoing process, right? A transaction can repeat, a settlement can repeat, a distribution can repeat, a transfer can repeat, an application can generate activity over and over and over again. So when I evaluate the potential utility of a blockchain, I am not impressed simply because somebody tells me the token is scarce. Scarcity is interesting, but scarcity combined with real repeatable utility is a much more meaningful economic conversation. So let's go back and talk to let me make crypto completely take crypto completely out of the conversation for just a minute. Because supply and demand is not a crypto concept. It's an economic concept that has existed forever. So think about it this way. Imagine there's 100 seats available for an event. And in our first example, there's only 80 people who want those seats. There's more seats than buyers available. 20 seats are still sitting there available. Now imagine there are still only 100 seats, but now 150 people want them. Nothing changed about what the number of the as far as the number of the seats go. What changed was the demand. And now let's say that you have, imagine there's another 20 seats that suddenly become available. The supply goes from 100 to 120. Again, the demand didn't change, but the relationship between the supply and demand changed. And that is the basic concept. But there's another side of this that's especially relevant to us as node operators. The people who own something also decide what they are willing to sell and what they are willing to accept for it. There are people out there, no judgment, that are willing to sell their TSC coin for $20. There are people that have sold their coins for $16. This week, you might have noticed that at one point our token hit $90. Some people sold their coins for $90. Some people sold them for $60. When we started to see the selling, that's when the price starts to come back down, right? Because there's more selling happening than buying. So buyers decide what they are willing to pay. The buyer decides what they're willing to pay. The sellers decide what they are willing to sell for. And where those two sides meet is where a true market discovers price. And we're still early in our discovery. Just to be fully transparent, we have a small amount of trading volume that's happening right now of buyers and sellers. It's growing. And as we continue to move towards the direction of a DEX and T7X coming out of full beta, and eventually we expand onto other exchanges, as we go down that path, you'll continue to see the market cap continue to grow. But that relationship is still there. It's always going to determine the price. That becomes very important later in this presentation because TSC may be distributed by the protocol, but distribution does not automatically mean selling. So node operators and other holders ultimately make decisions about what they do with the trusted smart chain that they receive. I want you to keep that thought in the back of your mind because we're going to come back to it here in just a little bit. Now, we can bring blockchain back into the conversation. Let's say a protocol can define a maximum supply. What's our maximum supply, guys? In the chat, anybody? What's our maximum supply? That's right, 21 million. So a protocol can define a maximum supply. It can define how it's issued, its issuance. It can define the fees or the fee mechanics. Those things can be written into the economics of the network. We call it the tokenomics, right? But look at the other side of the slide. The protocol cannot force, it can't force the adoption. It can't force people to use an application. It can't force an issuer to put an asset on the network. And it cannot dictate the price buyers and sellers will ultimately agree upon in an open market. That comes from actual economic activity. And this is why I want our community to become very educated about utility. Because if all we ever talk about is just scarcity, we're only talking about one half of the equation. The better conversation is this. What could cause people, businesses, applications, and issuers to actually need the network? What could cause people and businesses and applications and issuers to actually need the network? Because if there's no reason to use something, scarcity by itself is not enough. Now, let's talk a little bit about Bitcoin. Bitcoin gives us probably the cleanest example of programmed supply. Most of you have heard about the Bitcoin halving, but I want you to understand why people pay attention to it. When Bitcoin launched, approximately 7,200 new Bitcoin could be produced per day through the block reward. And then the reward was cut in half. Now, just so you guys know, and this is just kind of a side note, but for your information, the Bitcoin blockchain operated differently than ours. At the time, if you were operating, or even still today, if you're operating a Bitcoin miner, you are competing. You're competing against other miners to solve these mathematical equations, and then a block is rewarded, and there's a certain amount of token that's awarded with each block. So today we operate nodes and they work synergistically together to validate transactions. And so blockchain has evolved quite a bit over the years. But when it launched, 7,200 approximate Bitcoin could be produced per day through a block reward. Then the reward was cut in half. So approximately 3,600. then approximately 900. And following the 2024 halving, approximately 450 new Bitcoin per day were being minted. We follow, Billy chose those exact same tokenomics. So every 4 years, roughly speaking, the amount of new Bitcoin coming into circulation through the block subsidy is reduced. And that is something that the protocol controls. This is really important. This is not a company that's controlling this. I use this as a selling point often when I'm having conversations with prospects because they'll say, well, what if something happens, and your company goes out of business? It doesn't matter. Prosperlink could go out of business tomorrow. We sell the nodes that support the network. But what you have to understand is the protocol is controlled through a smart contract and it can never be altered and never be deviated unless there is a community-wide vote where it's unanimous and ultimately that were to pass. That can't be changed. So what you have to understand is that's something that the protocol controls, but here's what the protocol does not control. It doesn't control whether 1,000 people want Bitcoin or 100 million people want Bitcoin. It doesn't control how much of the existing Bitcoin holders are willing to sell, and it does not determine the price buyers and sellers will ultimately agree upon. The supply schedule is programmed, demand is not. And I'm not showing you Bitcoin because I'm suggesting that TSC will do exactly what Bitcoin does. They are different networks with different use cases and different economics. I'm showing it because Bitcoin gives us a very clear example of how a declining issuance schedule works. Now, let's talk a little bit about this. Let's look at what happened under the essentially the same Bitcoin supply rules at different points in time. So around the May 2020 halving, Bitcoin was trading at $9,000. Crazy, right? Just 6 years ago. 6 years ago, $9,000. I think we just about hit 70 again yesterday. So later, during a period of significantly greater demand, it reached approximately $69,000 in November of 2021. Now, here's an interesting side note. Think about where we're sitting in Bitcoin right now. Do you realize that in November of 2021, people were celebrating, cheering, so excited because Bitcoin hit a new high of all time, 69,000. Today, we are in a bear market, slowly starting to climb out of it, in my opinion. And we're sitting at 69,000 and people are bummed about it. And the thing is people were lining up to buy Bitcoin when it was at 69,000 and there was energy and hype everywhere because it hit a new all-time high. There was a line out the door to buy it. Today, when it's now at a low, there's the fear index is high and nobody wants to touch it. Isn't that interesting how that works? So you got it hit 69,000 in 2021. Then you look at 2022. There was no new halving. The Bitcoin subsidy remained the same, but the demand conditions changed dramatically. So liquidity contracted, the risk appetite changed, and parts of the crypto market, the credit market collapsed. And Bitcoin ended that year at roughly $16,500. Then in 24, you started to see these Bitcoin ETF shares were approved for listing and trading in the United States. And by March, Bitcoin had reached another new all-time high. So why am I showing you this? Because I don't want anybody walking away thinking that a declining supply automatically creates a particular price. It does not. Supply matters, demand matters, liquidity matters, and ultimately the market is the interaction of all of those things. And that is the lesson that I want us to take away from Bitcoin. Now, if you look at Ethereum, Ethereum gives us a different lesson. Bitcoin is a great example of program scarcity. Ethereum helps us understand utility. When somebody uses an application on Ethereum, makes a swap, interacts with a smart contract, moves a stable coin, performs another chain action or an on-chain action, that activity consumes what's called block space. And to use that block space, users have to pay transaction fees in Ethereum. Ethereum has their native token, which is the Ethereum coin, and anything that is built on top of that network. And it doesn't matter what exchange that it's traded on around the world, it requires those transaction fees to be paid in Ethereum. Now, I want you to think about that for a moment because this relates to the T7X licensed digital trading platform. We are the native token to the T7X licensed digital trading platform. There is a functional reason for the token to be used. The network is performing something, and the native token participates in that process. So under Ethereum's structure, their fee structure, part of the base fee, they also burn it. So now you have the actual network activity interacting with the token economics. That does not mean more Ethereum. Activity guarantees a higher Ethereum price. That's not necessarily what I'm saying. What I'm saying is it's is much more fundamental. Utility can create observable use of a native token and repeatable use of a native token. That's the lesson. And that leads us to the framework that I think every node operator really should understand. So when somebody talks to you about the utility of a blockchain, you guys probably, you're in the node business. Those of you that are affiliates, I'm sure you get hit up by a node project all the time or a blockchain project. Let me give you 6 questions that will very clearly help you to evaluate any cryptocurrency project. And I'm going to tell you that most cryptocurrency node projects out there today cannot answer these questions. They can't give you a sincere and honest answer because they're relying on the marketing side of things. So, number one, what problem does the network solve? If you really get down to it and you move past the marketing and the hype, I want to know what problem that it solves. There should be an actual reason for the technology to exist. Number two, who actually needs to use it? Is it consumers? Is it businesses? Is it applications and financial institutions, traders, investors? If the marketing wasn't there and the hype wasn't there, why would anybody actually need that coin? Number three, why does the solution need a blockchain? What does blockchain provide that is useful to this particular problem? In our case, it provides instant settlement. It provides transparency. It provides the ability for real world assets to be traded in the secondary market. Number four is this is a really important one. What role does the native token play? What's the native token of the blockchain and what role does it actually play? Our native token is required for all of the transaction on the digital trading platform. It's required from a transactional standpoint. It's also required that the real world assets, once they are listed, pay their distributions in the trusted smart chain coin. It's one thing for activity to happen somewhere in an ecosystem. It's another thing for that activity to actually require or utilize the native token. Number five is what creates authentic network activity. What actually causes transactions? In our case, we have real world assets that are clearing the SEC so that they can open up a capital raise, right? That requires for those individuals to go open up an account at the T7X licensed digital trading platform. From there, when that token is listed, that creates on-chain activity. It creates transactions and settlement and transfers and distributions on the licensed digital trading platform. And all of that requires gas fees. And finally, who supports and maintains the infrastructure? Because none of this happens in a vacuum. A decentralized blockchain requires infrastructure, and this is where the node operators come into the picture. And then I would add, well, what's the governance of those node operators? Is it a truly centralized company where there's a handful of people that are making all the decisions, or is it decentralized and governed by a legal charter? So when somebody tells you this blockchain has utility, don't just accept the word utility. Understand what the utility actually is. And real utility means real users performing real functions, creating repeatable activity across infrastructure that's capable of supporting it. Now, where does our utility come from? We talk about this in all of our presentations. There's several potential sources of utility within the ecosystem. One is real world asset activity. If assets are tokenized and their workflow takes place on the trusted smart chain, that can create network activity. Another is settlement. If distributions or other documented settlement processes take place using the network, that creates another functional role, right? We have smart contracts. Smart contracts allow rules and processes to execute on the trusted smart chain according to how they have been structured. And then, of course, there's trading and transfers and transaction activity and network fees on the T7X licensed digital trading platform. We have our real world assets that are required to pay their distributions in TSC. Once again, they're listed on the licensed digital trading platform on T7X. I want to be very deliberate with the way that we think about this. The question is not how many projects can we just say we're associated with TSC. That's not enough. The better question is, what are those projects actually doing on the network? Who's using it? What functions being performed? What role does TSC play? And how does that activity flow through the infrastructure that we as node operators are supporting? And that's where the utility conversation becomes much more substantive. Now, let's talk a little bit about how the RWAs can turn into reoccurring network activity. This slide is really important because I want you to see an RWA as a workflow rather than as just some logo or company, right? It begins with an issuer. The issuer has a real world asset and creates the legal and technological structure around tokenizing that asset. Then you have the holders or investors who own or interact with that asset. Then you have smart contracts that perform certain documented functions. Distributions can occur, settlement events can occur, ownership can change, transfers can take place, trading may occur. And that's the piece that I want you to recognize. Those actions can be repeated. And getting an RWA onto a blockchain is not necessarily the end of the utility story. It's the beginning of the ongoing workflow. Because if an asset continues making distributions, those are reoccurring events. If ownership changes, meaning somebody that owns the coin that they invested in, right? They invested in a real world asset and they decide that they want to sell and ownership changes. Those are additional events. If trading occurs on the platform, swapping or trading from one coin to the next, those are additional events, right? When smart contracts execute, those are additional events. Smart contracts are controlling the tokenomics of these real world asset coins and their tokenomic structure. So I would encourage you when talking to somebody about RWA strategy, not just to say we have real world assets. You know, as you start to understand this more, you'll start to understand that workflow creates repeated, sustained demand, right? Workflow helps, it's why the underlying infrastructure matters so much. So let me give you an example. So let's put some numbers around this so it becomes easier to understand. Let's say, for example, only, hypothetically speaking, let's say an RWA raises $50 million, and let's say that it has a illustrative 10% annual distribution. That would represent 5 million in distributions over the course of a year. So if those distributions were made quarterly, you'd be looking at approximately 1.25 million in buying of the TSC coin every quarter. Now, here's the part that is directly relevant to Trusted Smart Chain. Once an RWA is listed on T7X, the distributions are required to be paid in TSC. So in this example, 5 million worth of value would need to be distributed to investors in TSC over the course of that year. Guys, that's real functional use of the native coin. But I also want you to understand what it doesn't necessarily mean. It doesn't mean the issuer has to go into the market on the exact day of the distribution and purchase 1.25 million of TSC. They could acquire TSC in advance. So, in my opinion, real world assets, it would behoove them to acquire the TSC coin when it's priced at its lowest price points and accumulate because they know they have distributions that they're going to need to meet in the future. So they could source it periodically. So distribution volume and immediate buying pressure are not always the same thing. What is meaningful is that TSC has a required function within the distribution process. And once you understand that, the next question becomes much more interesting. What happens if it's not just one real world asset? What happens if it's 10? What happens if it's 100? So this is where scale starts to become very interesting. Using the same hypothetical example, one $50 million RWA with a 10% distribution will distribute 5 million of TSC over the course of a year. Well, if those distributions occur quarterly, that's 4 reoccurring distribution cycles. Now imagine 10 similarly sized real world assets. Now, the illustrative annual distribution becomes a lot higher, right? Now it's 50 million with multiple distribution events occurring across the ecosystem. Now imagine 100. Under the exact same hypothetical assumptions that you're taking about the 500 million of annual TSC distribution volume, who are they buying the coins from? They're buying them from you guys. And you get to decide when you want to sell. Now, again, I want to be precise. I'm not saying that equals 500 million of immediate market buying pressure. Nobody's going in and buying 500 million in one day. But I'm showing you how the functional requirement can scale. And that is the bigger picture of us for node operators. One RWA can create activity, but man, if many RWAs begin using the same underlying blockchain, the network can potentially support increasingly large amounts of recurring economic activity. We're not building separate infrastructure for every asset. They're utilizing the same underlying network. Now, let's talk a little bit about this. May be one of the most important slides in this presentation because this is where I want you to see how both sides of the market can begin interacting. And I want to emphasize before we go any further that this is a hypothetical example. It's not a price prediction. It's not a prediction that there will be definitely 50 or 100 or 500 RWAs. We hope that there will be thousands of real world assets that are on board. Hang on one second, guys, real quick. Give me 1 second. So let's see here. Satin is preferred for the baseboards and casing. Copy. Okay. Okay. So we are simply using round numbers to understand the mechanics of supply and demand. So in this illustration, let's assume that the average RWA creates approximately 3 million per year. I'm going to use a conservative number of 3 million. So let's say that each RWA creates approximately 3 million per year of TSC buying demand in order to meet its distribution requirements. So at 50 RWAs, that represents approximately 150 million of annual demand of TSC. So at 100 RWAs, it goes to 300 million, 500, it goes to 1.5 billion. Billion. Now, notice that I'm not assigning a future price to TSC here. I don't need to. The lesson is simply that as the number of assets using the network grows, the potential demand for the native token can grow with it. Now, you guys can use common sense and you guys can arrive at your own conclusion about what you think could possibly happen at that point in time. The protocol distributes approximately 7,186 token per day, or approximately 2.6 million token over a year. After the first 4-year period, now we have a halving schedule. And that daily distribution, it gets cut to 3,593 TSC per day. So some of you understand very clearly why where you are right now, and from a node operator perspective, is a lot. It's a better position than somebody that comes in 4 years from now. Some of you understand the benefit of operating multiple nodes right now because you're accumulating more TSC coin when the distribution's at its highest. So after the next halving, it goes to 1,797 TSC coin per day. So conceptually, you can have one side of the equation where potential utility drives demand. Its driven demand is growing as the ecosystem grows, while the amount of new distributed TSC is moving in the opposite direction and declining according to the protocol. Now we get to something that's very important for every person, every node operator to understand. Distributed supply is not the same thing as supply offered for sale. Distributed supply, which is the 7,186 coins that are going out, is not the same as the supply that's offered for sale. That's where the community plays an active role, and you guys have some control here. When you receive TSC, you have choices, don't you? You can choose to stake it or lock it and support the network, or you can choose to hold it, or you may choose to use it within the ecosystem as more real-world assets are listed onto the T7X platform, or you may choose to sell it and make it available to somebody who wants to buy it. The protocol determines how much new TSC is distributed. The protocol does not make the individual decision for every node operator about what they do with their TSC coin that they receive. You have choices. And that is the point that I really want you to understand, because if demand for TSC grows because more assets and more applications require it, while the protocol issuing is declining, the final piece is how much existing TSC holders and node operators are actually willing to make available to that demand. You guys understand how important that is? You get it? Got it, Ron? You get that, right? So buyers decide what they're willing to pay. Sellers decide what they're willing to accept. That's where the market meets. And again, none of this predicts a future price, but I can tell you that supply and demand, it's not magic, it's just math. Right? I mean, I remember when I was growing up, my mom and dad collected, I think Rick's on here, so they collected these things called Beanie Babies. Did anybody collect Beanie Babies back in the day, just out of curiosity? Tim, you remember those? It was crazy. It was crazy how much some of these Beanie Babies were selling for, especially the rare ones. Do you guys remember like the Princess Di Beanie Baby? I mean, some of these things were selling for thousands of dollars. Why? Because they were scarce. It's just where the market meets, right? So my point is this. If the community collectively says, hey, we're going to support this network, we believe in it, and we believe in the potential of the future, and we're going to lock up for 2 years. And everybody collectively made that decision that they were going to do that. What happens to the total supply that is available in the marketplace? It's locked up, right? It's not available, becoming more scarce. And as more real world assets come on chain and they have to buy, and there's not that much available, well, again, you guys can decide what the potential result is of that scenario. Now, we're getting close to wrapping up here. So as the declining issuance changes the supply side, let's go a little deeper into the supply side. The current daily distribution is 7,186 under the stated tokenomics. That issuance is designed to decline over time through a 4-year halving schedule. So just like we discussed with Bitcoin, the protocol provides visibility into the rate at which new supply is created. There's another part of the TSC economics that matter as well, and that is staking and locking, right? Again, participants can stake or lock ranging from 30 days up to 2 years, according to the applicable program rules. 20% of the daily distribution is allocated to the staking pool. You guys realize that's 1,437 coin that are going into the staking pool every day. Why does staking matter in supply and the demand conversation? Because TSC is locked, it's not immediately liquid and available for sale. So I want to be accurate here. Staking does not magically make supply disappear, and staking by itself does not necessarily create demand, but it changes the amount of supply that may be immediately available to the market. And that's an important concept because the total supply and the available supply are not necessarily the same thing. So this slide makes that concept easy to see. Forget TSC for a second and imagine there's 100 units of something, 30 are staked or locked, 10 are being held or used, and are not currently being offered for sale. That leaves 60 units that are immediately liquid and potentially available to the market. Now imagine demand is only 40 units, but there's 60 potentially available and only 40 being demanded. There's plenty of available supply relative to the current demand. But now keep everything else exactly the same and increase the demand to 90 units, but there's still only 60 immediately liquid units available. The total supply never changed. It's still 100. But the relationship between the amount people want and the amount actually available to them changed dramatically. This is why I want our node operators to understand that circulating supply so you can make a well-informed decision whether or not staking or locking is right for you. I choose to support the community. I have a long-term vision. Every single coin that I have is locked for a period no less than 2 years. Why? Because I don't go into any node project with less than a 3 to 4 year mindset. Why? Because I understand that true infrastructure takes time. So I'm not telling you what to do. That is not any advice. That's not advice. I'm telling you what I choose to do. So the community participates in the supply side. If somebody stakes, that has a different effect on immediate liquidity than selling. If somebody holds, that has a different effect than selling. If somebody chooses to make their TSC available to the market, that adds to the supply buyers can access. And the protocol establishes the rules. The market participants make their own decisions within those rules. So a node operator participates in infrastructure. This brings the entire conversation back to you. There's different ways to participate in the ecosystem. Most people understand the user or holder side. Somebody can go to a market and they can acquire a coin. They may hold it. They may transfer it. That's the participation at the user layer. A node operator is participating differently. You're operating network software. You're supporting infrastructure. You're part of the distributed network that verifies and shares information and supports the consensus. And then there's the utility layer. That's where the RWAs come into play, right? These layers all work together, and without users, there's no reason for an application. Without applications or functions, there's little reason for network activity. And without infrastructure, the network has nothing to operate on. This is why I've always wanted our node operators to see themselves as more than somebody who just receives a digital reward, because you're participating at the infrastructure level of the ecosystem. There's no guarantee of a financial outcome for doing that, but there's a meaningful difference between simply acquiring a coin from an exchange and actually participating and supporting the network that the coin belongs to. So when those supply and demand interact, now you look at the demand side first. More real world assets actually use the network. Documented structures require TSC for certain functions, and projects create reoccurring network activity. More issuers and more applications can create more use. That's the demand side. Now look at the supply side. New coin entering the market, new issuance follows a defined schedule, and that declines over time. Some node operators and participants choose to stake or lock. Some choose to hold or use their TSC rather than immediately selling it. Others, the amount of that is actually available in the market can be very different from the total amount that exists. And this brings us back to the basic economics that we talked about at the beginning. If demand grows faster than the amount of supply being offered into the market, buyers can begin competing for the available supply. That's what we're aiming for. If the available supply grows faster than the demand, the opposite can occur. That's how markets work. And you should notice that nowhere in the explanation did I have to make a price prediction. We don't need one, because if you understand the mechanics, it's more valuable than making a prediction. I put this slide in here because many of you are going to have conversations with other people about what you've learned today or in the next coming weeks or months ahead. And I want our community to become very good at explaining this accurately. We don't need to exaggerate the story. The truth is good enough. The story is strong enough when we simply explain what is actually happening. So instead of saying utility guarantees price appreciation, utility can create ongoing sustained demand, network activity. That's accurate. Instead of saying staking makes the supply disappear, explain that staking can reduce the amount of TSC that's immediately liquid and available. Instead of telling somebody that every RWA automatically creates a certain amount of buying pressure, explain what we actually know. That once it's listed on T7X, the RWA distributions are required to be paid in TSC. And that creates a functional requirement for the token, a functional use for the token within the process. How and when an issuer sources that TSC is going to vary. And never tell somebody that owning or operating a node guarantees a return. It does not. What a node operator does is participate in supporting the infrastructure. And I think we build more belief, not less belief, when people realize that we are willing to explain this intelligently and accurately. We don't need hype. What we need is understanding. That's why we've chosen the route of education. An educated community will always be stronger than a community built only on excitement. Why? Because they behave differently. They behave like stakeholders. So 5 takeaways here. If you forget everything else I said today, I want you to remember these 5 things. First, supply is the starting point. Understand that the maximum supply, understand issuance, understand how it changes over time. It declines over time. You can read all of this in our white papers at trustedsmartchain.com. And immediate liquid supply and total supply are not the same thing. The second is utility gives a demand a reason to exist. The more important question is not whether a coin is scarce, it's whether somebody actually needs the network and whether the native token performs a real function. Third, reoccurring use is much more interesting than a one-time event, isn't it? Transfers that repeat, settlement that repeats, distributions that repeat. Fourth is node operators and the community participate on the supply side. You make individual decisions about whether you stake, whether you lock, whether you hold, or whether you sell your TSC. Those decisions collectively influence how much supply may actually be available to the market at any given time. And fifth, infrastructure has to be supported. Real utility requires real users, but it also requires a real network capable of handling that activity. And that is the role that every one of you plays. So instead of asking only what will TSC be worth, I want our community asking more intelligent questions like what has to happen for utility to become real? What is my function and role in the community? Because if you understand the answer to these questions, you understand the bigger picture of what we're building here, what's going on here. I'm not going to sit here and read you to this disclaimer, but I do want it on screen because the way we communicate matters. This is education. It's not a prediction of future value. There's no guaranteed profits. You guys know that. There's no guaranteed appreciation, no guaranteed outcome from operating a node, holding TSC. But what we can do is we can study the economics, we can study the infrastructure, we can study the utility, we can watch the real world assets progress, we can understand how distributions work, and we can understand how the native token participates in those processes. That's where I want our focus to me. So for me, the big takeaway from this entire training is very simple. Supply matters, but supply by itself is not the story. Utility gives a demand or a reason to exist. Reoccurring utility gives that demand the potential to repeat. And the protocol determines how new TSC is distributed and how the issuance changes over time. The community determines what it chooses to do with the TSC that it receives. And the node operators help support the infrastructure underneath it. So my hope today is that you got a deeper understanding of how the entire ecosystem works and this is how we build an educated community.